With me now is Mahesh Nandurkar, India strategist at CLSA India. Mahesh, thank you so much for joining us on NDTV. I just wanted to understand that, as a strategist, how are you seeing the global liquidity phenomena? Are the old days of 15, 16 PE becoming average or slightly expensive are gone behind, and PE itself has got re-rated all across?
No, true. It's a very valid question. I would attribute a large part of the market re-rating in India that we've seen over the last few months, largely to this particular factor which you're mentioning, which is the improved global liquidity. There's an improved Indian liquidity as well, but yeah, global factor is pretty big because we now have almost $12 trillion worth of government bonds globally, which are trading in the negative yield territory. So there's clearly dearth of investment ideas with the international investors, and from that perspective, emerging markets and Asian markets and India are looking better and better, in that context.
Right. So, I personally know that you look at a lot of global markets. It's not only an India phenomena. Across the board, we have seen PEs re-rating.
Oh, absolutely. Absolutely. We have seen the market getting re-rated pretty much across the globe, starting right from the US markets, and you can look at the Japanese markets or, even the other emerging markets. And while here in India, we feel very enthused about the way Indian markets have behaved, and that's rightly so. But, one must keep in mind still the fact that year to date, Indian markets have underperformed the other emerging markets on a US dollar denominated basis. So while the markets have done well, it's, as you rightly said, it's pretty much a global phenomenon.
Right. Here, for our viewers, it's very difficult to take a call, and even for you, it's very difficult to take a call. When will this global liquidity go? But just a guess. When do you think this liquidity would go? As of now, it's ready and it's here to stay.
Yeah, as of now, it is clearly there, and some of the events have actually added to that liquidity. We have seen a massive, massive reduction in the yields of the Japanese bonds. We have seen some of the European sovereign bonds also going into the negative territory. And after the Brexit, especially, the market is attributing lower and lower probability of any potential rate hike in the US. So all these factors put together, it looks like that the global liquidity is here to stay. Also, keep in mind that with the Brexit and the potential of that threat spreading to the rest of Europe, we have started to see some flows coming out of developed market and going into emerging markets such as India. So, all these factors clearly highlight that while the valuations is a concern, but these liquidity factors will probably keep these high valuation sustained at higher levels.
In such a scenario, how would you look at India, the best growing market, probably the most stable market? Our currency has been the best. So if there is any P rating, if there is, if this liquidity were to continue, India will be the biggest beneficiary?
India will clearly be one of the one of the better markets, from more structural point of view as well. I would say that it makes sense to kind of stay invested. But the thing is, at the same time, we never know when this liquidity flow can ebb. So this is one risk that we still have to keep in mind. From that point of view, the investors need to be cautious because, while the markets have run in probably an unexpected manner over the last 2-3 months, don't forget the fact that the same things could reverse as well. So I think best to keep focus on good quality names, the sectors and the stocks where you have earnings visibility, where even if the liquidity were to turn for adverse, the potential negative impact can be limited.
Right. We'll talk about sectors which can do well later, but just wanted to understand about India earnings. How would you look at the current macro situation in India? What sort of pickup are we seeing, and what is market factoring in? How would you balance these two?
So I clearly believe that if you look at the valuations and take that as the barometer of what the market expectation is. So currently the Indian markets are trading at between 17.5 times to 18 times on a 1 year forward earnings basis. Historical average has been about 15.5 to 16 times. So we are clearly about 15 to 20% higher in terms of the valuation as compared to the last 10-year history. So that clearly tells you that the market is building in a lot of positives already, whether the passage of the GST bill or whether the expectation of a potential rate cut after the new RBI governor comes, or whether the possibility of a fiscal stimulus from the government side. We already know that they have set up a committee to review the fiscal targets. So I think a lot of these factors are slowly beginning to kind of get factored in to the market estimates and the market valuations already.
So, some of these would come over a period of time. It would start to have an impact on the earnings. As of now, as a strategist, are you seeing after the Q1 numbers, whatever we've got so far, are there any chances that 15-16% plus growth can be met?
So we believe that the earnings growth for FY17 should be around 12-13%. The next year, which is FY18, could be around 15 to 18%. So this trend is clearly much better than what we had seen in the previous 2 years. So the previous 2 years, which is FY15-16, the earnings growth was almost 0%. So on an absolute basis, we are clearly looking at a much better number this year and the next year as compared to that. Now the market expectations, if you look at the consensus expectations at this point in time, they are higher than the numbers that I've told you, which is higher than 12-13 and higher than 15-18 for the next year. So from that point of view, I think there is a possibility of a disappointment, I believe. And that is still something to keep in mind. But on an absolute basis, the earnings trajectory is still on an improving track.
Right, but that's largely factored in the 17 times number that we just discussed about?
Yeah, I mean, I don't think there is much potential for the markets to re-rate further. Unless you see even bigger kind of monetary and fiscal stimulus globally and also in India, then it's a different matter. But it's difficult to play the market today for more PE re-rating. I think we have to now focus on the earnings growth, and that is likely to be the single biggest driver.
In your recent report, you've highlighted two things. So one is the NPA issue and how we come out of it, and second is the slowdown in the real estate space.
Right.
How important are these two things to track for the next 4 quarters so that 12 or 14% number can be achieved?
Yeah, so I think the NPA risk is at this point in time pretty well flagged and known, and a lot of market participants are focusing on that already. But I think the real estate slowdown is something that is not well factored in or not well understood by a lot of market participants, I believe. And I think it's a very core to the overall economic growth improvement. The residential housing accounts for 8 to 10% of GDP and accounts for a quarter of the gross fixed capital formation. So when we talk about investment cycle recovery or the expectation of that, the property market recovery is a very, very integral part of that. So till the time the property markets do not show signs of stability or do not show signs of improvement, it's very difficult to envisage a broad-based economic recovery, because ultimately the construction sector, the property sector is the biggest job creator, is the biggest employer. Also, there are other factors like the cement demand, the steel demand, etc., that also are linked to which way the property markets are moving. And I believe that as of now, we are not really seeing any signs of recovery over there. My sense is that give another 6 to 12 months and at least some sort of a stability should return to the property markets. And my base case is that in another 12 months' time, we should begin to see some recovery on the property markets, onwards.
So, there are two ways property markets would go up. One is that volumes start to pick up, inquiries start to pick up, we see inventories which is there, start to get sold. And second is that the pricing may actually pick up. Now, prices have not corrected a lot.
Right.
So, do you believe that it will largely be a volume-led recovery or recovery where we see more transactions happening versus what's happening now?
True. See, the thing is, we have seen price correction, by the way, it might not be the headline price correction, but we have seen price correction in the form of registration free or stamp duty free, or there are some this 595 and 1090 scheme wherein you put in 90% of your capital 3 years or 4 years down the line. So at a capital cost of 10%, it's actually a pretty big discount that are being offered.
So basically SOPs are being given.
SOPs are being given, and I would say that effective price cuts to the tune of around 15% or so have already been effected over the last 24 months. So as I said, maybe another 5-10% of price correction would be needed, or maybe kind of in some form or the other, may not be the headline price cuts, as I said. But I think at some point in time, the affordability factor is going to start reflected in the demand. I mean, we have seen the mortgage rates coming down by about 100 basis points or so over the last 12 months. Maybe you get another 50, 60 basis points going forward. The incomes are rising, although at a lower pace, but they are still rising. So I think at some point in time, the affordability factor will begin to support the property markets.
The next big factor is that the job creation has not been as good as it should have been, or as it was expected.
Right.
How big a problem is that, not particularly for real estate, but overall consumption, overall economy?
No, it is an issue, and it is actually not just an economic problem, it's a very big political problem as well. Just to give you some numbers, according to our calculation, we are adding almost 5 to 7 million unemployed people every year. And so, my estimate is that, by the time we get into the next election, the unemployment rate in India would be about 10%, which basically means that out of the, let's say, 60 crore of total employable population in the country, about 6 crore will be unemployed. That's a pretty big number. And as I said in the beginning, or in the early part, that construction sector is the biggest job creator. And I personally believe that ultimately the government will have no choice but to support the property sector, in the housing sector. I mean, we have already started to see more noise being made about housing for all and so on. But I think that is one segment, whether in the affordable housing segment, whether in the form of housing subsidy, whether in the form of tax cuts for the mortgages, etc. I don't know which way it is going to transform. But ultimately, in order to create jobs, the property markets have to have some sort of a recovery. And I feel that is one segment that the government will need to focus on, and that is one segment where even the investors need to focus on as well.
Right. As far as job markets are concerned, how important is it for consumption in the economy? Because unless that happens, consumption would not pick up.
That's true, absolutely. So the thing is, the problem with the jobs is not so much associated with the job creation only, but it also a lot to do with the demographic. So according to our numbers, about 5 million new jobs are being created every year, whereas the requirement is more like 10 to 12 million. So it's not that the jobs are not created, but it's because of the demographic pressure, more needs to happen. But yeah, to come back to your original point, more the jobs getting created, obviously more will be the consumption and the impact on the staples and so many other consumption sectors. So from that point of view as well, it's quite important.
Right. So that was about the real estate market and how it can happen. So next is the NPA thing. As you said, a lot of AQR processes already happened. We know about the NPA. How can it lead to further downgrades into this year or maybe next year?
So my sense is that we are still not out of the NPA cycle just as yet. We will see the NPA ratios rising during FY17 and possibly peaking out sometime in early FY18. So the trend is still on an increasing side. In fact, some of the results that we've seen in this 1Q so far supports that conclusion. So my sense is that some of the banks that have more gearing towards the corporate sector will still continue to face this as an issue.
Right. And as far as as the NPA cycle increases, do you expect more asset sales to happen? Because one of the reports suggested recently from a rating agency that a lot of assets which used to yield money have actually got sold. So now most of the assets that are remaining with these debt companies are assets which are not yielding anything. So do you believe that will also be a problem? Now a lot of assets are not yielding?
I think there are still a lot of good quality assets which can still be traded or which can still be sold to generate more cash. So I don't think that the asset sales story is over as it. I mean, we have seen some bit of that happening on the infrastructure side already and cement side, etc. But I mean, I think there is much more room for that to still unfold.
And capitalization of PSU banks, I mean, is that something that you believe that which has already taken place? We've seen some numbers coming in. Do you believe that more will need to be pumped into that as you expect NPAs to increase?
Yeah, I clearly think so. More will need to be sort of pumped in because the government came out with the budget of around 250 billion rupees or 25,000 crore for this financial year. My sense is that is not going to be enough to kickstart the public sector banks, the lending process. And given the fact that 70% of the outstanding credit is with the public sector banks, and some of the banks are not well equipped in terms of the equity capitalization to kind of do the lending growth, I feel that the overall economic recovery still is dependent on the health of the public sector banks. So I clearly believe that more is needed over there.
Mahesh, I know you cannot talk about stocks, but the recent 25,000 crore number also that we got had two big banks getting a large amount. So SBI got a very, very big amount. But if you look at some of these names, their capital adequacy ratio is fine. They don't need money. So do you think that allocation of those funds would also be important?
Yeah, so some of the large PSU banks, have reasonable capital adequacy ratio, and they can probably, see the loan growth still sustaining, especially with the kind of monies, which is being made available. So the problem is not with all the public sector banks, but yeah, some of the smaller, tier 2, tier 3 public sector banks definitely have an issue, I believe.
Right. So, from your report, financials is one of the key overweights that you have. So, as you're saying that corporate side of NPA is not looking that great. Plus, you don't expect a lot of pickup in capex also very soon, at least till about next 12 months. So, how would you play this financial space?
So, I would like to play the financial space largely with the private sector players, where there is no issue of capital availability to start with. So, these are some of the banks that can still grow the credit or still grow the book, by somewhere between, let's say, 15 to 20%. Not all of them, but many of them can. So notwithstanding the overall economic recovery, some of these banks can still grow at a healthy pace. And also then within that, some of the banks that have not that much of an exposure to the corporate segment, which have NPA issue, etc.
Or towards the retail side.
Towards the retail side, will be the safer bets.
Right, but some of these names, at least in the large cap ones, very well-known retail banks have done very well. Their valuations are very high.
Right.
Plus, we've seen very huge competition from NBFCs coming in. Something like Axis, which is known like a corporate bank, also wants to grow into retail. ICICI wants to do that. So, don't you think that a lot of competition there would increase?
No, competition is there, but if you look at the outstanding credit of overall NBFCs, all of them put together, it is still under 10% of the total banking sector credit, right? So while there is an increased competition from the NBFCs and there is an increased competition even from the PSU banks, I mean, while you have the large PSU banks, in fact, they are also a very big part of the overall competitive landscape. But I still feel that the visibility of growth or the visibility on earnings, it's still the best in terms of some of these retail-oriented banks, and I feel that keeping in mind some of the risks on the valuation, especially on some of the mid caps and some of the other more leveraged names, which have been propped up because of the global liquidity, which has been improving for some time. And as I said in the beginning, you never know when the tides turn. So keeping those kind of risks in mind, better to be on the safer side. You may not get an exaggerated return, but whatever that you will get will probably be more stable.
Right. So, the NBFC point that you mentioned, apart from that, even yields going down is a very big positive for the NBFC sector, at least for the wholesale funded. That's the reason why these NBFCs have got re-rated?
Yeah, that's definitely one of the reasons. The second reason is also a lot of these NBFCs have an exposure to the rural markets. And, we believe that with the monsoons being reasonably good this year, and also the various government initiatives to kickstart the rural economy would ultimately, play out. So that has also helped, these NBFCs.
Right.
And plus there is, some M&A activity which has just about started. You could see more such things going forward.
Within your portfolio, one name which is property is an overweight. So, that's one thing that, people don't want to own.
Right.
You particularly have been tracking real estate for a very long time.
Right.
So, 2007-8 was different where, they were buying anything, they were taking loan, they were very, very aggressive. Do you think in the last 7-8 years, these things have changed? They have become less aggressive, they have focused more on delivery, and entire real estate working has changed?
Oh, I definitely feel so. Because 2007 was a completely different ball game, where every developer was just trying to buy as much as land parcel as he can. That has clearly changed over the last 10 years. So we have seen some element of discipline coming in. Although the return on equity ratios are still very, very low for many of the players. So I would, then therefore focus on the property companies which have been, let's say, more disciplined, which have reasonable ROEs, in double digits. And then within the overall space, we also have a preference for the companies that have some sort of exposure to the office segment or the retail segment, because that is the segment which will possibly see some action going forward in terms of REITs which could give a fillip to the valuations on that side. Also, the fact that the rates are coming down or likely to come down going forward would also help the valuations on the on the rented portfolio.
Right. Some of the companies that you mentioned which have disciplined, or some of the companies within the sector has disciplined, some don't. Right. But most of these large cap companies which had huge debt issues, they have tried to solve out. Most of them have come out also. So there is a lot which has changed within the large cap players.
Yeah, as I said, by and large, there has been some deleveraging which has happened, and by and large, there has also been, the case where there is greater discipline today than what it was, 8 or 10 years ago. But as I said, it is a sector where one needs to be very, very selective, and one can't really use just a broad brush.
Right. Two sectors. So one is, of course, within metals, Vedanta was one of your big calls. Right. You may not be positive on steel, but you believe that in metal space also there is a lot which is changing, and a lot of delta could be created going ahead as well.
See, as I said, I'll not be able to comment on specific stocks. But yeah, the thing is, what has happened, in the metal space in the last, 3 or 4 months, or the commodity space in general, is that the big worry around China has come down materially. And, we've seen, there has been, stimulus within China itself, and the demand, seems to be doing okay in China at this point in time. And, a lot of those factors have led to the re-rating of the global commodity space in general, whether it is oils, whether it is metals, including steel, etc. So a lot will still depend on what happens, in China. And as a house, we continue to have, a slightly cautious view, on the prospects of, economic recovery over there. So I would say that, it still remains a bit of a risky space, and which will continue to be quite volatile.
Right. So, within energy or say metals pack, oil marketing companies here in India would be the best place. Would that be the best way if somebody wants to take exposure to this sector?
Yeah, oil marketing companies clearly will look like a very attractive option at this point in time. Not only because we've seen the oil prices stabilizing at a lower level, but also we have to keep in mind that the government has been very, very disciplined in protecting and maintaining the marketing margins. That has always been a concern with the global investor community, that the state-owned oil marketing companies are susceptible to the government policy changes, and the marketing margins and the subsidies kind of burden can come at any point in time. But I think we've seen a pretty disciplined approach from the government on that front over the last 2 to 3 years, right, which I believe is not well factored in as it. And yes, the valuations are pretty reasonable as well.
Right. So one place where you may not be comfortable with valuation would be consumer pack. But we've seen monsoons coming in, which of course is a positive. We've seen the 7th pay commission coming in.
Right.
All these companies like Havells have not been growing for the last 2-3 years. So the base effect has also come in. So despite the recent run up, you think consumer durable is a space that is still attractive for growth?
Consumer durable space, as you said, has had its own valuation related issues. But yeah, there are some triggers in the form of a potential GST is going to be very good for it. As you also mentioned, the 7th pay commission can lead to higher growth in the discretionary consumption space, which is basically what the consumer durables are, including autos. So there are some of these tactical positive triggers that one can look forward to. So yeah, so as a space, it looks reasonable given all these tactical sort of things which you just mentioned. Yeah, but valuation, is once again something that we have to keep in mind, which is not a factor that favors, I would say, most of the stocks in the consumer durables, or the staple space.
You think that valuation factor for the consumer durable space is coming in because of last 15 years we've only seen rally into the consumer pack?
See, that is true. Over the last, I would say 5 to 7 years, the overall investment related activities in India have been quite weak. So the investment plays have not done as well, whereas the consumption plays have done very well. And so this was also kind of seen by a lot of investors as a good place to hide, and that continues to be the case. And as I mentioned in the beginning, with the yields globally going into the negative territory, the stable growth option as kind of as has been made available by the consumer staple sector, although at a very high PE multiple, but the stability of the growth continues to attract a lot of investors to this space. But as I said, the valuations are clearly in a very, very, higher sort of, zone, and, may not necessarily sustain, at these levels. One other issue that the staple sector also faces is that last year in FY16, we saw the benefit coming in from the margin front as well, because a lot of global commodities, the prices were going down. Now this year it looks like a lot of those global commodities are on the up. So the margin benefit is unlikely to be there. In fact, you might see some companies actually getting impacted, because of the margins, and impacted because of the input prices going up. So I feel that you will have possibly a situation where the revenue growth remains more or less similar, and the margin tailwind not being there, there is a good possibility of earnings level disappointment in the staple sector.
Right. As far as the sector-wise earnings is concerned, IT is only probably the one sector which has entirely delivered number X12 companies. How would you look at IT? Q1, the strongest quarter, we've seen commentary not that great, margins were lower, sales growth was not there. You think there is a structural change in the Indian IT space?
I wouldn't say structural, but yes, IT is not really as high growth an industry which it has been in the past. This year, FY17, I don't think the earnings growth is going to be more than, let's say, 10%, maybe in the 5 to 10% range, especially because of the cross-currency issues, right? Because a lot of these IT companies do a lot of business in the UK and in Europe as well, where the currency has depreciated. And so to that extent, those companies do get impacted. But yeah, next year, FY18 will be much better. We think the earnings growth will be back into 12 to 15% zone. And this is one sector where I still believe that the valuation versus growth equation is still quite reasonable.
So that's why it should be, and that's why one should look at the large cap space.
Yeah, certainly.
Right. IT was always traditionally known that it'll grow 10%, 12%, 15%.
Right.
So would you just wait for the Q3 numbers, Q4 numbers to come in before going aggressive to buy IT?
Yeah, I don't think there's a need to buy IT aggressively here. But I believe that it still needs to be a core part, of your portfolio, because this is one sector which still has that 12-15% earnings growth visibility without too much of a downside, I would say, over the next 2-year period. And as I said in the beginning, I think valuation is not something that is palatable for many sectors, whereas IT is one sector that kind of stands out where the valuations are pretty reasonable.
Right. As far as healthcare is concerned or pharma is concerned, do you think things there are changing? For big companies, we've seen EIRs coming in, we've seen a lot of approvals coming in. Of course, the M&A activity has reduced in the sector. But do you think things are changing over there and that can lead to a huge FY18 growth?
I think FY17 is likely to be a much better year for pharma sector as compared to last year. Because over the last couple of years, there have been many issues. There was some M&A related activities, and the disappointments came through because of the synergistic gains not coming through. Also, the US FDA has been very active. Now, a lot of those things are in the base, and which depresses the base. And on that low base, FY17 actually can be a very good year. So we believe that the earnings growth over there can be well in excess of 20-25% for many stocks. So that's one good thing, but that is more near term. I believe that the longer term concerns on the overall growth opportunity in the US still continues to be a factor, and is evident from some of the very expensive valuations, some very expensive acquisitions that some of the pharma companies have made. So that goes to show that the possibly the growth opportunities are not as much as it was a few years ago, and the companies now need to make expensive acquisitions to buy growth. So that is something which will probably work against the sector.
Mahesh, just a last word for our viewers. So you're bullish on property, you're bullish on private banks, you're bullish on various sectors. Can you just name 3 sectors in the order of preference that one should look at to buy on every dip?
So, I would say that, from the earning stability point of view, as I said, as a course of our discussion, we quite like, IT, we quite like private banks. We also quite like energy segment, basically helped by the OMCs and some of the other large caps. So those are some of the stocks that I feel has a decent, equation between valuation versus growth outlook.
Right, Mahesh. Thank you so much. Always a pleasure talking to you.
Thanks a lot, Pankaj. Thank you very much.